Hello and welcome to another episode of the Flux News Show. My name is Harry Campion-Evans. I'm standing in for Greg today, and I'm joined in the studio by Harinder and Vincent from the research desk. On today's show, we will be talking about the volatility in the fuel oil and the distillates market. We'll be talking about Chinese crude buying, and as ever, Trump tariffs, whether they mean anything or not. So really hope you enjoy the show. And to start, we will cut to the temperature check. Harinder,
Let's kick it off. So I think this week we've seen a bit more organic bullish momentum. We've been talking about the fact that in prior weeks there's been tons of headlines coming out. This week has actually been, prices have been responding far more to fundamentals, we could say. If we start with volatility, maybe we'll kick off with the open interest in the different strikes. So it's actually been quite an interesting week with the response to the sanctions that President Trump has proposed on Russia, the 100% secondary sanctions. We'll talk about that in the herd mentality a bit more so. So how's that been affecting the options market? Well, if we take a look at my screen here, we can see that there's a premium that started to be priced again for the calls. So if we look at the 70 and 75 strike for the September Brent options, we see this $2.45 premium, which is a pick up about 60 cents over the week, which is particularly interesting because in previous weeks, again, this $6 premium we were seeing during the peak of the 12-day Israel-Iran war has mostly eroded away, but the market is still pricing a little bit of uncertainty, the upside as a consequence of the sanctions and the disruption to oil flow there. Another interesting point, I think, is the $95 strike, because we see this huge OI that's maintained itself over the course of the previous weeks. And we've talked about that being basically a volatility play, but now is coming to its end.
That was the strike that we talked about maybe like 6 weeks ago or something, right?
Exactly.
Where was it like a couple of funds that piled into the 95 calls?
Exactly, yeah. So a massive volatility play, trying to take advantage of moves to the upside. Now that the OI looks really high, which is a bit deceptive, our options trader thinks that the reason that is that the bid offer on that strike is pretty poor.
Right.
Those traders that would have bought it have just sold the delta out of the option. So they've basically taken away the directional exposure. So if it goes up or down, they're like neutral.
Right, but they don't want to liquidate the option because it's too expensive to trade out of
Exactly.
it. Okay.
It's in a liquid strike. So that's the options market. If we move quickly on to volumes on my screen here. So a fairly muted week in volumes. We have seen a bit of a pickup in the previous week. This is the September daily traded volumes. I think the officials table kind of puts it together really nicely. So we see this 10% increase week on week for the September Brent future. We'll also see this mimicked a little bit in OI, where we've seen a slight increase in overall risk being deployed in the main futures contracts, and in the CFTC and CTA positioning we'll come to later. We'll see this general uptick that's kind of concordant with the bullish momentum we've been seeing. Prices on this kind of like trend, so slight trend upwards quite nicely.
Yeah, across the board. And you've got gas oil. So gas oil is like a 34% change.
Exactly,
big, like a 77% change. There's some quite big changes there, right?
Absolutely. And gas oil, again, we'll come to
we'll talk about gas oil in a bit, right? Because a lot of this rally could be sort of seen to be potentially gas oil driven. Some interesting stuff there, which, we'll talk about that later.
Absolutely, yeah. And then if we move to OI, as I mentioned before, a little bit of an increase in open interest, especially in prior weeks. We've talked about how the 12-day war was very options driven and an options driven market in previous weeks. And we can see that here now that OI in the futures, this is the M2 Brent future, has picked up quite significantly. So another indication that there's genuine risk being put on. And then we'll see later in our macro mayhem section with the CFTC positioning, how that's reflected there. So I'd say a pretty warm market, bullish momentum, Russia sanctions kind of in the limelight.
Cool. Vincent, would you agree? Warm market?
Yeah, certainly warm market seems to be a much more sustainable one with the focus back to fundamentals, whereas last couple of weeks with the geopolitical risk premium, that was quite volatile. Now it seems to be a sustained build-up of momentum.
Yeah, and refinery margins are still strong. Like the underlying North Sea crude market's still strong, right?
Fairly strong, yes, fairly strong.
Cool. Okay, so now it's time for the herd mentality section.
So on the herd mentality, we could say the week has been split between two predominant topics. One is on the gas oil distillates rally, as I mentioned earlier, and then later last week, towards the beginning of this week, more focus back towards geopolitics and tariffs with Trump's policy initiatives. So on the diesel and distillate side, the fundamentals have been extremely strong, indicating a very, very tight market, especially with inventories of like distillate stocks in the US and also in Northwest Europe, the ARA region, being below seasonal averages. In the US, it's seeing counter-seasonal draws at a time when it usually sees builds. As well as that, money managers, the hedge funds, are piling into longs in both gas oil and heating oil futures, and they're at the most bullish level in nearly 2 years.
Right.
So these are all very, very strong bullish indicators. And to add to that, the July-August gas oil future spread expired super high at $69 per metric ton.
Yeah.
That was last week, which is the highest level in almost 3 years since the peak of the Russian invasion of Ukraine.
Yeah, and that spread, because I guess the viewers might not have the kind of context on that spread. So the July gas oil futures is a physically delivered contract, which has a very prompt delivery in ARA. So as it gets towards expiry, it becomes like very kind of, well, potentially fundamentally driven. So I spoke to a couple of traders in ARA and some in the Middle East, and like, the kind of universal message is that like ULSD barrels are like super tight. So no one really wanted to short that spread into expiry because no one really, it was mainly just completely demand driven. There was a bit of panic over barrels coming from the East. Like you said about the low stock levels, people just, it gave the impression of a very distressed market, because obviously by choice, people aren't buying, an expiring future at $111, I think, which was like the highest the time spread traded over the next month futures. And actually, when you look into the swap market, the diesel differentials, so the bow month diesel differentials, which trade at a differential to the underlying gas oil swap, they have actually been rallying as well. So I think the bow month ULSD 10 ppm diff to gas oil has moved up about $25 in this whole move as well. So it's ULSD driven for sure. And when I spoke to some guys in the Middle East, they were saying, it's a seller, like the impression is that it's a seller's market. The buyers are scrambling for barrels. The sellers in the Middle East are sitting on like high offers. They're not moving. They know they've got the barrels. It's tight. Stocks are super low. So it's just like a real seller's market. And I think that expiry was a very distressed expiry. And like you say, you've got that kind of momentum now, fund managers piling in, and gas oil cracks kind of outperforming Brent, even on a Brent rally. So it kind of feels like it could be a very distillate driven rally at the moment.
Yeah, certainly on the charts on the charts here we show there's a couple relevant graphs and headlines about it. So you're seeing how low the distillate stocks are. That's on the bottom left, and on the right hand side you have two charts. One is on data Brent, the other is looking at the gas oil prices. So there seems to be a bit of a correlation between that, in the sense that the strength in distillate cracks have been also driving refinery buying in spot crude. So that's really elevated the physical market in recent times, especially with backwardation and Brent future spread super strong, and also stated Brent being very strong in the August time periods. So from in the first half of August, perhaps that's when we've been also observing a lot of refinery buying in these areas, not just trade houses, indicating that there really is a demand for that to be met, and that's been attributed to higher distillate cracks. And at these levels, refiners see these very, very high margins, and they just, so even though the barrels are more expensive, it's still worth getting it in order to like lock in these margins for producing gas oil and diesel.
Yeah, and I guess as well, coming into winter, when you have that sort of peak heating oil demand period, if the US stocks are super low and ARA stocks are super low, it's, potentially create like a very tight market coming into sort of September and October. So I guess maybe the fund managers, spec guys, are all starting to sort of pre-position for that, because if these stocks are kind of counter trending, like you say, it's not good coming into the winter at all. So I guess the question is like, hey, is this going to be a kind of a sustained distillate driven rally? And sort of bull market coming to the end of the year on distillate cracks.
Yeah.
Anything else in the herd mentality?
Yeah, so the other part was the headlines coming out recently regarding Trump's renewed tariff threat, sending a litany of letters to the US's trading partners over the week, reinforcing the 1st of August deadline to reach a deal reach a deal, or these new rates of tariffs would be set. So over the past weekend, that was 30% tariffs towards the EU and Mexico, and also 35% on Canada last week. So renewed tariff threats, but also talking about perhaps a policy pivot towards Ukraine, sending in more sophisticated weapons, more Patriot missiles, as well as, in his conversations with NATO Secretary General Mark Rutte yesterday about perhaps imposing more sanctions towards Russia if a deal isn't made within 50 days, which the market sort of shrugged off.
Yeah, it kind of feels like, well, my might not agree, but my view is that the market is kind of shrugging off pretty much anything Donald Trump says now. I mean, I think he's kind of alienating his voter base a little bit in this whole, he was very adamant that he was going to promise to stop the wars and everything. And now, he's kind of pivoted to funding Ukraine, sending them weapons, sanctioning Russia. I think he just assumed that he could get it done, like he said, on day one. But it seems like recently he's kind of falling out of favor a bit with his voter base. I know, not energy related, but with the Epstein files and all that stuff. I think he's kind of pissed off quite a few of the sort of MAGA voter base. And this, I saw some tweets of some sort of fairly famous people who were following him saying, I voted for you because I wanted to stop the war. And now, you're saying sending Patriot missiles or whatever to Ukraine. You don't know how much of it's just, he's just trying to talk Putin kind of down a bit, but I don't know, but it just feels like it's just like with Trump, it's just all right, mate, we'll believe it when we see it, kind of thing. He just sort of
absolutely
says a lot.
He does.
The fact that he's coined his own taco phrase for how much of a he is, says a lot about him.
It does kind of feel like the whole Liberation Day thing is happening again, like the whole rhetoric of stick to these deadlines and these tariffs, and the market has this huge reaction that it inevitably ends up getting reversed. It just does feel again like that. And although I think interesting is that some trade ministers, EU trade ministers, have been on record saying that 30% tariff level, if it were to be maintained, would effectively nullify transatlantic trade. So the agreements, that the sort of the flow there would be massively.
But I think energy is exempt from these tariffs, right? Because we saw there was no. I don't think it was kind of abundantly clear at the start, but there was no reaction from RBOB or EBOB really. So. A big transatlantic trade on the gasoline, which is barrels moving from Europe to the US on gasoline. You didn't really see any kind of reaction there at all. So I think it's kind of assumed that it might even be, agreed now that the energy is exempt from all this. So I don't know.
It'll be an interesting one for sure. And then there was this whole headline yesterday about the 72 billion euros counter tariffs, which again just feels exactly like the US-China tit for tat.
Yeah.
Likely again we see this reversal take place.
It just gets diluted, and eventually they just sort of hope that everyone just forgets about it and they just do something meaningful so they can
PR
attack. PR, save face, and then just sort of back down and distract everyone with something else.
Exactly.
Yeah, that certainly seems to be what did eventually happen between the US and China. There were tit for tat tariffs initially, and then both sides sort of backed down, although the base rate for tariffs are still much higher than what was before. So I believe with China still paying a 55% tariffs for its exports towards the US, but I guess both sides were backing down. China exporting more of the rare earths, and US, I believe, overnight there was a headline on them on Nvidia being allowed to send some of their semiconductors into China. So these are sort of some exceptions. So it's not just the baseline rate of tariffs.
Yeah, that makes sense.
Almost like hitting it where it hurts and removing these sort of restrictions.
Yeah, I see. Okay. And then on the topic of China, do we have some? Is there any the Chinese buying on crude? Has that made it into the herd mentality?
I believe so, somewhat. And of course, there's been talks that China are increasing their crude imports and increasing inventories. I believe raising their strategic stockpiles, but. I believe that's what the officials will be discussing today.
Cool. So I think now is a good time to cross to the officials, carry on this conversation. So Vincent was just talking about the Chinese buying. What do we have on that?
Yeah, so we've been seeing a lot of Chinese buying. Specifically, we saw allocations from Saudi Aramco were pretty massive this time around for August barrels. And that's also coming at the time where we had pretty expensive OSPs. They were pricing above what structure would imply. So that tells you there's a lot of appetite in China for Middle Eastern barrels at the moment. Do you want to talk through the data a little bit?
Yeah, sure. So we've got a chart where you can see the month-on-month change and the breakdown by refiners. So for August, we saw that the Saudi allocation rose to 51 million barrels, and that was the highest we've seen since we began collating this data back in July last year, and it's up from the previous high of 48 million barrels for the May allocation. So, as you say, there's clearly a big appetite for this Middle Eastern crude from the Chinese buyers, and you mentioned obviously the high OSPs. But on a flat price basis, it's important to remember that China does like to buy around $70, and the Dubai pricing has dropped significantly. So in Q2, it was averaging below $70, which is a big important point for them. So you've got them buying a lot. The price is definitely attractive to Chinese buyers at this point, and I think that the reason for that is, they're building these inventories massively, and
it's like strategic. It's about energy security. And China have always, the classic Chinese put at 70, flat price falls below 70, China start buying and we'll find a floor. And I think it's a similar situation here. What's interesting as well is if you look at the crude arbs on a delivered basis into China, it's really quite hard to compete with Arab Light. On a Suez basis, like per barrel for mid-August, Arab Light was about $2 cheaper than WTI VLCCs. It was just under $3 cheaper than 2P VLCCs, and over $3 cheaper than both Murban and Mars. So you've got a pretty competitive barrel there. So that's kind of going to drive a lot of the strategic stockpiling. But then we're also seeing that China is starting to ramp up and come out of maintenance season. More broadly in the macro data, we saw industrial production data print really quite strong today, and retail sales was a bit softer but still elevated relative to the 2024 averages, so the demand is there, and now especially among the state-owned refiners we're starting to see run rates pick up. So according to JLC data, since the 28th of May, utilization among the state-owned refiners has picked up from about 76% to almost 86%, so that's a big hike in run rates. Throughput in June was up about 8.5% year on year, according to the MBS, at 15.15 million barrels per day. So the Chinese industrial engine is starting to kick into gear again. So you've got this kind of twofold strategic build, but at the same time that they are starting to ramp up the refining.
You mentioned how competitive Arab Light is, but I would also like to mention the Iranian imports, because they in June increased by around 600,000 barrels per day. So it's not only the Saudis, it's also the Iranians that are really supplying this crude to the Chinese. And I think storage is kind of thought to be around 60 to 70% full. So at their current rate of filling up the storage, they've got another year till they're at maximum capacity. And so that would mean, Chinese buying isn't going to disappear in the near term.
And also we're coming out of maintenance season. So now we're going to have refinery capacity come back online. It's going to be harder for them to build at what they have been building. They're believed to have been building up to about, in some cases, 1.7 million barrels per day. So that's taking almost the entire global surplus that we're estimating at the moment. China's taking it. That's that they're going to start running that crude. I foresee China to keep buying for some time to come, as long as flat price stays relatively suppressed at current levels.
What are you looking out for then in terms of, are you looking out for certain things in the like the Dubai window, like the kind of next batch of allocations and OSPs? Like, what are you kind of looking out for as signs that this is a sort of sustained Chinese buying regime?
Yeah, for sure. I mean, so we've seen time spread structure in Dubai remain like really quite resilient.
Yeah, above $3 average for this month still, and very, very strong.
Exactly, and I think a lot of this Chinese buying is supportive of that. We'll also be tracking import export data, as well as looking at JLC refinery data.
I think the refineries will be a key indicator. Their run rates will be
exactly, because whilst state-owned refiners have picked up a lot, the independent refiners in Shandong are still below 50%. So when they start ramping up, that'll be big. There's also a lot of additional refinery capacity coming online this summer. So we'll be keeping an eye on that as well. But I think, the key one to watch will be Dubai time spread structure, paying attention for what the Saudis decide with their upcoming OSPs next month. They were pretty expensive this month. And I think they'll probably continue to be pricing them above implied.
Well, especially provided if they have this kind of guaranteed Chinese buyer, it makes sense, right, that they would increase the OSP quite highly. So that's what we're paying attention to.
Cool. And has there been anything kind of a note in the Dubai window the last couple of days?
I think it's been kind of more of the same, really. The structure of the Dubai window has remained fairly kind of a bit of an ebb and flow this month. We've had some days which have been much busier, others that have been quite quiet.
It's definitely picked up.
It's picked up significantly from June. Yeah, definitely. Because last month we only saw 3 convergences. We're already above that number so far, halfway through July. Yeah. So certainly on a month-on-month basis, there's a lot more activity. But we're not at the levels of kind of buying that we were in, say, April, May kind of time, and the 3 months when PetroChina and Vitol were really going all in.
Yeah.
Cool. All right, thank you guys. Okay, so let's move on to the crack spread chronicles. Harinder?
We've seen a little bit of a weakening in refinery margins. So if we look at the screen here, the Asian margin, with the exception of Q1 26, this is from our refinery margins report on Flux Live, we see a weakening for M1, M2, and Q4. The third part of the curve has remained a little bit supported, so that's up 13 cents. But yeah, the refinery margins as a whole have kind of weakened, and that's driven largely by the high sulfur fuel kind of coming off.
Sort of starting to see that, I guess, especially the Asian margins, right? So that sort of 380 cracks started to sort of wobble and come off a few dollars. And even, I mean, everything's still relatively strong, but from a sort of recent level basis, so we're what, $3 or $4 lower on fuel oil cracks.
On the crack, we had the chart. We had the chart in there as well.
We do have the chart also. Yeah, the chart spoiler for the Widowmaker.
Yeah.
But yeah, as you see on the charts, the cracks kind of come off substantially. That's the M1 by around $3 since the start of the month. So looking at the bar charts, it's indicative of potentially stop outflows, people trying to liquidate their long positions, smashing to the exit, perhaps on the back of like high supply.
Yeah, we've talked about, I feel like it's one thing we talk about in like almost every podcast, right? Is this sort of, we've been in like a sustained high margin environment for so long. We've talked about, what's going to be something that gives. And me and Greg have sort of entertain the idea of kind of shorting winter fuel oil cracks. But yeah, it does, I spoke to some of the fuel traders yesterday and sort of asking, because I noticed that the 380 East-West, which is the difference between the Sing 380 and the Rotterdam barges fuel, same spec fuel, different location, is actually quite deeply negative at the moment. And their sort of hypothesis was that you've had this sustained period of really high crack spreads in Singapore, and basically everyone has just pointed everything physically at Singapore.
Yeah.
There was a bull play to go with it last month. So there was a lot of physical buying which supported the paper on the bull play. And effectively now that's over, you're starting to get this delivered product kind of rolling into Singapore, but not the kind of physical buying appetite behind it. And actually there's just like an enormous glut now of spot fuel in Singapore, which is just basically collapsing the kind of prompt part of the curve. I think you've got the Balmo 380s West is pricing about like -20 or something, and the August 380s West is about -7, I think, was it closed last night. So yeah, sort of not sure if this is kind of the inflection, sign of a real inflection point where the kind of whole market corrects down, but margins are still high, and if fuel doesn't feel invincible anymore, it kind of maybe now is the time that it sort of does show a real correction, because sort of it doesn't look like it's going to come from gas oil. It doesn't look like it's going to come from gasoline even. I mean, gasoline's not exactly kind of setting the world alight, but it doesn't look like it doesn't look like it's ripe for a kind of collapse yet. So yeah, maybe fuel is kind of the leg that's finally going to go. But yeah, I suppose on dated Brent, I mean, what are we seeing on dated Brent recently?
Yeah, on dated Brent, it's been particularly overall the market is bullish on the back of very strong Brent future spreads. And on a dated sleeve basis, which is dated Brent against Brent futures, that has also been historically high in both the front month and the second month. That's September dated Brent. So on an outright level, that's super strong. But on the actual physical windows, it's been, let's say, sentiment's been quite mixed. You have a mix of buying and selling flows. So selling flows from US refiners such as Exxon or P66, or even trade houses like Glencore, Mercuria. Whereas on the buy side, you have Chinese players such as PetroEnergies, Unipec, but also from Total. But on a physical differential basis, there we haven't seen much like bullish aggression in the sense of pushing the print higher. It's just been supported at an okay level, whereas so we're looking at July pricing in mid-July right now, but the strength of the curve, as we mentioned earlier, that's in the first half of August, which has been driven by a lot of this refinery buying. So in a sense, it means that in the August tenors, it's these weeks are pricing the physical as super high, but we're skeptical that there's so much physical appetite to actually from speculators to push the actual physical differential to these higher levels. So in a sense, overall the market is quite strong, but it's not in the front, but that's more in the August region. So overall there's quite a lot of demand, but the question is whether the CFD rolls can maintain their strength as it enters pricing into August.
Yeah.
So it is a mixed picture. The question is, can the strength sustain itself? And also dated seems to be a bit overbought at these levels because all of these refinery buying, which has kind of distorted the curve stronger.
Yeah, I guess you're going to have, like you said about the Chinese buyers, and if they're on this sort of regime of buying, I think I even saw an article this morning that they sort of said, this is how much we want to buy. And, I guess there's going to be an expectation that there's sort of like permanent bid now from Chinese buyers on dated Brent as well as Dubai. So, but like you say, I suppose it's all relative to margins and where it makes sense for them. I think the guys were saying that it's quite an expensive, the North Sea barrels are, not as competitive as the Arab Light. So yeah, it's sort of, where does it all make sense versus freight and refinery margins? But I mean, at the moment, like, margins are still, fairly healthy, right? Like there's no reason why refiners would stop buying at these levels, and we're not sort of seeing like a significant sell-off. I think naphtha cracks are still quite well supported. I think there's actually been some refinery buying from Dangote, right? They've been buying naphtha for their reformer. So there's been some more demand from West Africa for naphtha. So those cracks are kind of holding fairly strong. So yeah, it's not immediately obvious where the sort of weaker margin is going to come from. Yeah, I mean, maybe it's fuel, but yeah, we'll see.
Certainly, yeah, bit of a demand floor, as we can see, at least in the North Sea. It's been capped by these Midland crude coming into Europe, but then there's some baseline support, as we saw of Chinese buying of 40s. Anytime, whenever the ARB does become workable, these 40s will be bought and fixtures will be sent into Asia. So yeah, quite a balanced market at these high levels.
Yeah. Cool. All right. Anything to add to that? Or
I think one thing we've mentioned in previous weeks about the third part of the curve being, so basically this idea that we've somewhat undersupplied refinery capacity going to tail end of the year. And refinery maintenance obviously is around the October period. China's been coming out of it summer, so there's like the additional refinery burn there. There's this interesting, I think on Trading Corner it's been mentioned a few times that product spreads that are quite supported against crude spreads effectively.
Yeah.
So you have this like tightness in products because of the undersupplied refinery capacity.
Yep.
So I think that in the coming weeks and months, as we see, we're likely to see the gas oil strength continue, and where the fuel continues to weaken. It'll be interesting to see how that plays into the dynamics for the refinery capacity, whether or not it basically supports. We'll have that refinery capacity online to bring the crude spread, like as you said, the strong naphtha cracks, whether they can bring that back down and sort of into balance, if you will. So
right, okay, yeah, makes sense. Okay, so moving on to the section where we talk about the winners and losers for the week. Let's start with the gold rush.
Yes, so the gold rush, as we mentioned previously, we've kind of hinted at it, really is the gas oil crack and the gas oil future. So if we take a look at the chart we have here, this is the
future.
This is the gas oil future, the rolling front month. We can see this massive rally that we've seen. And a roll, I guess that's the roll, right?
Yeah.
I think the big red candle is the roll.
Yeah, that's the roll. So so that's basically just not really an indication of price action, but that sustained rally we've seen over the last couple of days. And really, it's the CTAs and money managers that have formed during this rally. So based on positioning data, we can get up now. We've seen over the course of this time, managed money players have accumulated positions. Net length has been increasing, driven by an increase in longs, and also similarly with CTAs. Responding to those long run moving averages, sort of crossing over each other. In the case of the chart, we can see that the
gas oil future.
Gas oil future, the moving average is crossing over, and that's sort of triggering the buy signal for the CTA. So it makes sense completely that those are the players that have really done well over this period. We also, maybe this might be a good moment to show you guys the Onyx Markets diesel dashboard we have. So really, of course, it takes time for the prices of gas oil to filter down into what you might expect to see at the pump.
Yeah.
There's lots of there's taxes and there's duties that have been added, so it's unlikely to correspond one-to-one.
Yeah, well, and actually, like I think earlier when we said about the ULSD differentials, which are actually the kind of sort of more linked to the sort of road diesel that we're pricing here on the Onyx Markets dashboard, those diffs have also been strengthening against gas oil. So yeah, you know the spot pricing for sort of physical diesel in the UK is going to be really strong, because those prompt differentials have blown out, you know, $25 I think this month. So yeah, even on a strong gas oil market, you've still got the kind of outside strength in the ULSD. So yeah, sorry, you were saying about the pricing for the pump. But...
No, absolutely, yeah. I think it's really critical to sort of watch these things, because it's amazing how the effects in wider markets, like you see these futures and perhaps you think they're a bit detached, but in reality it filters right down to the
absolutely. And I mean, these guys are kind of turning tanks, you know, relatively quickly. So it doesn't take long for that. You know, we've been in a kind of relatively sustained period of strength in gas oil. So, you know, it doesn't take long for that pricing to start to filter through. So depending on how they work it, a lot of them buy on spot, a lot of them buy on sort of like a trailing average. But I think if we have these kind of weeks and weeks of strong wholesale diesel prices, it's gonna filter through quite quickly into the like price you pay at the pump. So I don't know. Can we just go back to that the Onyx Markets dashboard?
Yeah.
So what is it saying at the moment? So
current prompt price 140.6p per liter week. That's the weekly average.
So yeah, still a kind of pretty backwardated market in terms of, you know, the sort of forward prices being a bit lower. But yeah, I mean, if you can afford to wait to fill the car up, then we recommend you wait. But you know, obviously, you know, it's not always how it works. But yeah, you got quite a sort of steep backwardated curve at the moment in terms of the pump price. But yeah, I suppose on the going back to the sort of money managers, so on the kind of gas oil futures, so these guys would be long, you know, futures, options, cracks. You know, it's a very easy market to build size on. So yeah, I think you were saying as well, it's like the most heavily bullish positions they've been.
Yeah, it's been a lot. I mean, we'll get the exact dates perhaps in post, but yeah, it's the net length wise.
Yeah, net length. So out of the CDA net positions for the different oil futures contracts, they are the most bullish in European gas oil.
Right.
And yeah, so it is looking at from a price action perspective. It was impressive how the gas oil swaps price on the outright, it's breached $800, which was even higher than what was reached earlier just from the geopolitical risk rally, in the sense that the rally for the second time around was even stronger than the first time. So this really did show some tightness in fundamentals and a lot of strength there.
Yeah. And I guess, I mean, the kind of size that people can get on gas oil and, through options, cracks, flat price, and sort of scale of the move. I mean, this could have easily been like, well over like a kind of $1 billion in terms of P&L on this, last sort of six to 8 weeks as a move. So yeah, definitely some money being made there.
Absolutely.
Okay. And for the Widowmaker.
Yes, so let's go into the Widowmaker. People have lost big. We mentioned it before, the high sulfur fuel oil, the prompt crack. It was bound to break. I think we were talking about the high sulfur fuel oil being supported above, like cracks you were mentioning, Harry, a couple of weeks back. I remember being a positive high sulfur fuel oil crack was like so strange to see. And it's like, how long can we really maintain this for?
Yeah.
It's finally broken. If we maybe take a look at the chart. So this is the Singapore 380 crack. We also have the East-West that I think would be interesting to come to, but we've seen this before. And this is now the East-West, as you were saying, that it's
So where does the East-West sit at the moment? It's got
down to $7 per metric ton. So as the exact point you were making about the whole situation where there's this glut now effectively.
Yeah. So I think like this, this loss is not just going to be limited to the paper. I mean, no doubt that people have been kind of loading up on paper. All these 380s West spreads were all trading, like $10, $15 higher over the last few months. So, there's been a lot of length built through the summer on this stuff. A lot of physical length built. Again, like the traders were saying yesterday, there's going to be a lot of physical fuel, which people are struggling to sell at like a decent level. The 380s West, I'm sure there's been stopping out on spreads and East-West and cracks. I think there's the guys were saying there's still a couple of big physical buys who are sort of trying to defend it a bit. But yeah, I mean, you've got the kind of market moving like $4 or $5 down on cracks and $15 down on East-West and another sort of $10 down on time spreads. So yeah, I think this is kind of fairly significant Widowmaker in the same way that the gas oil was said about kind of how many avenues there were into it. I think there was length on spreads. We talked about it when we said the gold rush and everything was rallying fuel. People were long spreads, East-West cracks, probably flat price as well, and everything's collapsed at the moment on 380 in the prompt. So yeah, I think maybe it's run its course, maybe it's just a one-off, but yeah, I think there's definitely been some kind of significant P&L loss here.
Yeah, we would also want to highlight that open interest in these 380 contracts have been close to historical highs, at the very least, much higher than their previous 5-year highs, indicating that there's been a lot of risk deployed in these markets. So when these moves happen, because there's so many people in these contracts, because of so much risk, these positions are very overcrowded, makes them very vulnerable to stop outs, and oftentimes this would really amplify price action, this time downwards.
Yeah. And I think a lot of that length, people kind of hope that they sort of were able to price it out. It's not, when you've got like a really like high open interest market, ideally you want to sort of use the expiry to your advantage. And, if you have some physical behind it, like, sort of put on a bull play like we saw last month. But yeah, if the levels come off too much and you kind of get a tap on the shoulder from the risk manager, there's not much you can do. And then you have this instance where you've got a lot of people fighting for the sort of tables turn and sentiment turns a bit bearish, and then all of a sudden people are like, well, I'm not going to stand in the way of this. If there's length to be stopped out at high levels on 380 cracks, who's going to take the other side of it? If the market's kind of turning sour, and you've got the same thing on spreads and East-West, it just doesn't really work. But at the same time, people have kind of committed their physical product to Singapore. So yeah, I think now you've got that overhang, it's going to be quite hard for that to clear quickly unless someone kind of comes out with a real bullish agenda. So yeah, potentially a lot more pain to come, because I don't think this buying was just isolated to the front end of the curve. I think there's still a lot of length sitting out there, kind of hoping that it's not going to be a recurring theme. Okay, so now is the section of the show where we look ahead forthcoming week. It's the crystal ball section. So this is our view on Brent futures, Brent spread,
evil cracks,
and the Asian distillate crack, right?
That's right. Yeah.
But we can kind of talk distillate cracks. Okay, so futures.
Yeah, so on the future side, on the Brent futures, trading just at the high end of the 60s, around $68, $69 region, has come off a little bit from the low 70s since the end of last week, but we see a period of consolidation. So RSI is all pointing towards neutral momentum. What's very interesting is that looking at the purple line, that's where the 100-day moving average sits. So last week Brent broke above that, and recent retracements actually saw prices find support at this level. So this will be quite crucial around 68, and on the upside looking at $70 resistances. So overall very range bound market, and we would expect continued sideways action from a technical perspective, and if prices break out or break below, then we could see a bit of higher volatility get injected. So neutral for me.
No, you have to have a view. You can't say neutral because Greg's not here.
Oh, yes. Neutral. I'll say bullish.
I'll
say bullish just on account of previously spoken, the fundamentals we're still seeing strong refinery margins, strong backwardation, and geopolitical temperatures sort of it's rising ever so slightly. So with these factors in mind, and also positive economic data out of China, which we could interpret that for Monday and Tuesday, and as well as more macro data coming out of the US. And if that's bullish, then risk assets will be a bit more bullish, and that will feed into Brent future strength. So bullish from my side.
I think I would agree with that. I think sort of Chinese news seems to be supporting the market. I think there was a bit of a wobble yesterday with Trump saying and stuff, but I mean, in my mind, that stuff just fizzles out so quickly, and I don't really know kind of what it, it's a bit meaningless to me in the moment. So I think you've also seen this kind of move into sort of inflation protection, as you've seen Bitcoin rallying, gold rallying, silver rallying. So I think kind of makes sense that oil's rallying, with this always ever inflationary stuff coming out of the US, this big beautiful bill, which is just I think it's going to be inflationary, raising the debt ceiling, all that kind of stuff. And then strong refinery margins. So I'd kind of go bullish futures in the short term, and bullish the Brent spreads as well. I know I appreciate the Brent spreads are still quite elevated, but I don't see a reason why they would be selling off right now.
Just with the physical strength and data that we've been talking about, it does make sense. That's the Brent spreads at 94 cents. So pretty strong. I think I'd agree as well with the futures that as you say, the resistance at 70. It's been kind of this nice. It's range bound, but it's definitely trending upwards, I would say. And one thing actually in the options section we didn't mention that Hermione, our options trader, was talking about was that it's actually been a really good time for long gamma traders who will trade this range, and as it drifts upwards, it tends to be beneficial for them. So that could be another another gold rush point. But he said that in these markets as well, it's really the options traders that keep it range bound.
Right.
So they'll be selling the delta high and buying it low. It's selling and buying the underlying, keeping it in this range. But given it's trending upwards, that does tell you perhaps there's some more upside there. And so Brent spreads 98 cents per barrel. Yeah, I think there's a little bit. It can be supported. I mean, everything we've been talking about from a refinery perspective, from the buying we've seen in DFLs and dated. It's likely to keep this guy supported. So I'm bullish there as well. So bullish Brent spreads, bullish flat price.
Cool. And on the product cracks, I mean, I was quite bearish distillates for a while, just on a sort of broader, kind of macroeconomic picture. But I think just with the stock levels where they are, and just the general seeing how kind of tight this diesel market is in the RA, and speaking to these guys in the Middle East, and sort of didn't quite appreciate how tight the market is, and it clearly is responding that way. The July gas oil futures was a physical expiry, so that was indicative of real demand. So I think for me, sort of switching to a bullish distillates view, especially coming into winter.
Oh, absolutely.
You've got really low heating oil stocks in the US. I think that market's bullish for me. And on an EBOB crack basis, slightly harder to call. I'm kind of still in that sort of summer period, so I'm still going to sort of lean on the bullish side of that. But kind of less conviction on that one. But I think distillates distillate crack bullish for me.
Definitely. I think the deferred part of the curve for distillates is definitely be interesting to look at in the coming weeks. Like how it's responding, especially given, as you said, winter is a crucial period for distillates. So could be a very strong reason to be getting long there.
Yeah. What do you reckon, Vincent?
Could be a strong reason. Yeah, certainly the market or the positioning is quite bullish. The fundamentals are quite bullish. In that sense, I might instead take a contrary view and be a bit cautiously bearish in the sense that these high prices currently are a signal for refiners to be purchasing more crude and producing more of that gas oil to prepare for winter, especially ahead of autumn refinery maintenance, as well as seasonally strong heating demand in the winter time. So it's incentivizing a lot of production during the summer, and perhaps in a similar situation with the 380, with the high sulfur fuel oil 380 market, once enough of that it's getting produced and once balances adjust, and we could see a bearish correction, especially if all of these longs start to take profits. So I suppose at these levels, we could take a contrarian view on this.
Okay, interesting. Yeah. So you're bearish.
A bit bearish. Yeah.
You got a little bit of a.
What about EBOB?
On EBOB, it's we're in a peak summer demand season right now. Cracks have been pretty well supported. It's around the $15 level, I believe, in Europe. So I believe unless we see meaningful refinery outages or stronger macro headlines, we could see that correct lower going into winter. So a bit more bearish there as well.
Okay. In terms of hurricanes, I mean, I know it's not just there just yet, but I mean, there's not been much talk about the kind of hurricanes.
It's been more quite flooding in Texas and the like.
Yeah, I saw there was that bad flood in Texas, but kind of nothing nothing that the market's really reacted to in terms of hurricanes yet, right?
Particularly, no. Relatively quiet.
Nothing in particular, not right now, but I suppose when that does happen, then the market
I mean, you always have to be relatively reactive to that because you can't really, you sort of have to adjust your positioning quite quickly, and especially whether even depending on where it hits a kind of demand center or a supply center. So it's always pretty there's a lot of nuance to the hurricanes and kind of where it affects. So it's hard one to predict, but I just realized that I hadn't really sort of heard much about it. All right, cool. So we don't agree, but that's the beauty of it.
What's your view on EBOB cracks then?
I'm going to stick with bullish for now.
Stick bullish.
Yeah, I'm kind of bullish all four at the moment.
Okay.
And you? What did you say?
I think EBOB cracks. We get the chart. We'll pull up the chart. Yeah. So your argument was peak summer demand, but you're thinking that were you bearish on this one?
I'm bearish because I believe a lot of the strength has been priced in, and
already
for all bullish news, we would have to see refinery outages or, as you guys mentioned, hurricane disruptions.
Yeah, it seems that I think there's been a couple of times where EBOB has just kind of bounced off that high around, I think with the August crack, it's sort of it's like high 15s. As it gets towards 16s, it tends to sort of bounce down again. So we'll see. I think it's obviously struggling to break that level, but I'm gonna have to sort of stick with bullish for now.
I'll go with Harry then. I'll go bullish. I concur.
I concur with me. Right, good luck.
Yeah.
All right, guys, thank you for watching or listening. Be sure to like and subscribe our videos if you haven't already. And please stay tuned for our extended trading content on Flux Live.